Where do I go do I press watch now?
Yes. I'll do that quick intro for you, Mark.
Okay.
Good morning, and thank you for joining us, everyone. I'm happy to introduce our next speaker. His name is Mark Galashevsky. He has been an Elliott Wave International Chief Equity Analyst for Asia Pacific and Emerging Markets since 2008. In his monthly newsletter, the Asia Pacific Financial Forecast, APPF, Mark not only discovers opportunities in Asia Pacific and emerging markets, but also shows how mass social events are in fact driven by the same waves of social mood that create patterns in financial markets and how you can capitalize on that knowledge. He lives and works nomadically, having traveled to many of the countries he writes about, including Japan, China, South Korea, Hong Kong, Singapore, Thailand, Cambodia, Chile, Argentina, Brazil, Serbia, Bulgaria, Romania, Morocco, Egypt, and Jordan. A graduate of Middlebury College in East Asia Studies, he lived in Japan for most of the 1990s and is fluent in Japanese and conversant in Mandarin and Chinese. And with that, the floor is yours.
Okay, thank you very much, Mark. And good afternoon, everyone. My name is Mark Galashevsky. I'm speaking to you today from Santiago, Chile. This is actually an Airbnb. Anyway, today I'm going to be doing Q&A later, but I've prepared a 12-minute video for everyone that Mark is going to play for us. And then after the end of that, I'm going to take some Q&A, and we can discuss a lot of other questions even outside of the material that I discuss in the video. But the video can probably present, my production people back at the office have done a great job in putting together some good animations and other things. So I'll just let the video speak, and I'll see you at the end about 12 minutes from now. Thank you. Good afternoon, everyone. My name is Mark Galashevsky, and I am the Chief Equity Analyst for Asia and Emerging Markets at Elliott Wave International, a financial publishing company based near Atlanta. I'm speaking to you today from Santiago, Chile. The topic of the Money Show's virtual expo this time is capitalizing on metals, mining, and cryptos. The case I'm going to present to you today is that while both precious metals and cryptos will probably offer opportunities over the next 2 years, the two asset classes are fundamentally different, and therefore their long-term Elliott wave patterns have very different long-term implications for investors. Let's look at the charts to see why. On the surface, both cryptocurrencies and precious metals, or more specifically the leaders of each group, Bitcoin and gold, appear to be comparable assets. Both are outside the conventional monetary system and have provided a defense against inflation in recent years. But from a technical perspective, they have behaved quite differently over the past 15 years, with gold falling into a large bear market in the early 2010s and then accelerating higher in recent years, while Bitcoin has generally slowed its rate of advance over the course of its history. I'd like to propose to you that Bitcoin is in fact the proxy leader of intangible assets, which classes are fundamentally different and other global inflation in recent years, such as those in the Nasdaq 100 index. Bitcoin has roughly tracked the global infotech sector since its inception, so I will argue that it is dependent upon the same animal spirits that have made infotech the dominant investment class of the past 15 years. The implication is that where tech stocks go, cryptocurrencies are likely to follow. Gold, on the other hand, is the leader of tangible assets, which is to say, commodities. Gold has a long history of ebbing and flowing with the broad commodity indexes, shown here by the Bloomberg Commodity Index. Gold has shown much better relative strength than other commodities over the past 15 years, and I believe that behavior has long-term implications for commodities overall. Specifically, I believe that commodities began a supercycle advance in the year 2020, and that gold's outperformance in recent years is hinting at the extent of that supercycle advance, which I believe will last decades. I'll present my evidence supporting that thesis in a moment, but first let me give you a brief introduction to my methodology. The wave principle, or the Elliott wave principle as it has come to be known in recent decades, was discovered and developed by an American accountant named Ralph Nelson Elliott in the 1930s and 1940s.
This is the basic Elliott wave pattern. Financial prices progress in 5 waves, which are labeled with numbers, and regress in 3 waves, which are labeled with letters. A unique aspect of the methodology is that every progressive or regressive wave pattern, once completed, is itself a subwave of a larger pattern that is still developing. For example, the advancing 5-wave pattern and the declining 3-wave pattern in this sequence are just the first and second waves of a larger 5-wave advancing pattern that is still developing. Here we can see how that larger pattern is evolving, with the larger 5-wave progressive pattern followed by a larger 3-wave regressive pattern. And you can imagine that the larger up-down sequence is itself merely the first and second waves of an even larger 5-wave advancing pattern that is still developing. Elliott didn't have the word for it at the time, but today we would call his discovery of embedded self-similar patterns a fractal. Fractals are common in nature, and Elliott showed that fractals in financial markets are an expression of human nature. So now I can show you the logic underlying my forecast regarding intangible assets such as Bitcoin and Infotech stocks. Measured by the Nasdaq 100 index, the Infotech sector began a 5-wave advance in the year 2002 and is now in the final years of that advance. The fifth wave of a 5-wave pattern is often comparable in duration and extent to the first wave of the pattern. Therefore, because Wave 1 lasted 5 years from 2002 to 2007, and Wave 5 began in the year 2022, that points to 2027 as an ideal year for the sector to end Wave 5 up. This chart shows you a different perspective on Bitcoin and the global Infotech sector. The bottom graph on the chart is the MSCI Emerging Markets Asia Infotech Index. I've been tracking the developing 5-wave advance in the index in my publication for more than 15 years, and it looks like the Infotech Index is now tracing out intermediate Wave 3, shown in brackets, of primary or circled Wave 5 up. But if Bitcoin were to fall below the 100,000 level, then that would probably mean that primary Wave 5 in the Infotech sector would be near its end as well. To explain to you my forecast for gold and commodities, I need to show you a variation of the regressive ABC pattern. It's called an expanded flat correction, and it's characterized by wave B of the pattern rising above the start of wave A before wave C crashes below the low of wave A. Importantly, waves A and B of the pattern each have 3 subwaves, and wave C has 5 subwaves. Let's now identify that pattern in commodities. First, let me give you some background for understanding the long-term pattern in commodities and interest rates. Back in February 2020, in the middle of the coronavirus crisis, the Bloomberg Commodity Index was crashing with other global assets. But because of the clarity of the long-term pattern in the index, I provided a target for the end of the bear market in the 60 to 64 range. The actual low was 58.87, which the index reached about 2 months later. Then in September 2020, after waiting for an uptrend to begin to develop, I said that the target had been reached and that the bear market was over. At the same time, I forecasted enormous upside for commodities, price inflation, and interest rates when the yield on 10-year government bonds was just 0.72%. Now you can see the pattern I was envisioning in the Bloomberg Commodity Index. It was an expanded flat correction from the 1980 high, with Wave A ending at the 1986 low, Wave B ending at the 2008 high, and Wave C ending at the 2020 low. While the textbook clarity of the expanded flat correction was convincing enough, I pointed out another feature of the pattern that suggested the entire 40-year consolidation was in fact a second wave. That feature was the similarity of the larger expanded flat correction to a smaller expanded flat correction that had unfolded from 1963 to 1968. That smaller correction occurred in the second wave position of the 5-wave progressive pattern from 1962 to 1980. That fractal relationship added to the evidence that the next commodity supercycle would be a third wave that would last decades. Why do I say decades? Because the larger correction lasted 8 times the duration of the smaller correction, which meant that the subsequent supercycle advance would also last decades. And the price action since then supports that outlook. The arrow labeled UR here is pointing to the juncture within the smaller 5-wave pattern that is analogous to where we are at present within the larger 5-wave pattern now unfolding. If you consider that it has taken more than 5 years from the 2020 low to reach that analogous juncture within primary wave 3 up in the late 1960s, then how many years is it going to take for the index to reach the end of the larger third wave now unfolding? The answer is many multiples of the past 5 years. In the near term, the primary wave 2 corrections in both commodities and interest rates will likely continue for a while, which conventional observers will likely use to explain the continued advance in risk assets such as cryptocurrencies and infotech stocks over the next 2 years. But thereafter, the entire intangible asset sector should experience its largest bear market since the tech bust of 2000 to 2002, including the largest percentage decline in Bitcoin's history. Now let's look at the long-term pattern in gold. From its low in 1932, the metal has traced out a series of first and second waves at 3 degrees of trend. That means that it's currently in the middle of one of the most powerful patterns in the Elliott Wave Handbook, a third wave of a third wave of a third wave. Otherwise known as a third wave extension of a third wave extension, this pattern unfolds during extremely powerful bull markets, such as we saw in Bitcoin and global infotech stocks about 10 years ago. The only difference is that the pattern in gold is playing out over decades rather than years. Here are the years of the peaks and troughs so far in gold's multi-century uptrend superimposed on the idealized third wave extension pattern. If this analysis is correct, it means that we are currently in the sweet spot of the pattern, the third wave of the third wave of the third wave, which typically displays dramatic price acceleration. We at Elliott Wave International have been aware in recent years of the potential for gold to accelerate significantly. For example, here is the chart we published in Asian Pacific Financial Forecast in November 2022, anticipating the end of an expanded flat correction in the metal from the 2020 high. And here is the chart we published 2 years later showing gold leading silver higher in third waves at 3 degrees of trend. The next piece of evidence I can show you that supports my long-term forecast for gold is this chart of the total ounces of gold held by ETFs. Despite the extraordinary advance that the metal has experienced over the past few years, investors have mostly sat on the sidelines. The previous peaks in 2012 and 2020 show that bull markets in the metal tend to end on peak holdings. The fact that investors have been mostly indifferent to the current bull market supports our long-term wave count for the metal. Before I present my next piece of evidence supporting a long-term uptrend in precious metals, I need to explain to you another Elliott wave pattern called a contracting triangle. It's a regressive pattern that unfolds not in 3 waves, but in 5 increasingly smaller subwaves, until the price breaks out of the consolidation to new highs in a 5-wave advance called a thrust. The contracting triangle pattern helps us to understand the recent behavior in precious metals miners, which is our next piece of evidence supporting a longer-term uptrend in precious metals. Earlier this year, we noted that GDX and SIL ended contracting triangle patterns in 2023, which meant that their next major move would be a 5-wave advance to record highs. With the miners still tracing out third waves in the intermediate term, the larger advance in precious metals is also likely far from complete. The last piece of evidence I'll present to you today supporting a gold-led commodity supercycle is the long-term pattern in the MSCI Emerging Market Stock Index, which has tended to ebb and flow with commodities. The index has recently risen from its multi-decade channel line, which suggests that it has plenty of room to advance in coming years. If commodities have begun a supercycle advance, then emerging market stocks are likely to outperform in coming years. So I would encourage you to look for opportunities in emerging markets, since I believe the sector will be the key to equity portfolio outperformance during the commodity supercycle. Toward that end, I will now make a pitch for my own monthly publication, the Asian Pacific Financial Forecast, which has been identifying opportunities in Asian Pacific and emerging markets since 2008. The year 2025 has marked an important turning point for the publication, though, because this is the first year since 2010 that emerging markets have been outperforming U.S. stocks. I think that outperformance is not a temporary aberration, but a long-term trend in the making. So I hope you will consider subscribing by visiting elliottwave.com. Thank you very much for your time today, and good luck in your investments.
Okay, thank you very much. Mark, go ahead and you can begin choosing some questions if we have Q&A questions coming in.
Yeah, one moment. It's not, the video's not sharing anymore, is it?
Uh, you were playing it. No, it's not playing anymore, but it
Okay.
is visible. It's visible. Yes.
Okay. All right. So one of the questions that I'm seeing here is, what role do central bank gold purchases play in sustaining the bullish outlook?
They're very much part of the trend. That's again, pretty much whether you're a retail investor or a central bank, you're going to be influenced by the same psychological or how do you say, sentiment considerations in any particular market. So yes, central bankers are just as interested as retail investors in buying more gold.
Okay, perfect. Thank you. Um, what are the risks to gold safe haven status if digital assets continue to mature?
That's a really good question. And it's a philosophical one at this point in history. It's probably too early to say whether some digital assets such as Bitcoin may actually play a safe haven role. Of course, people believe that it already does. My thesis, of course, is suggesting that that's not the case, rather that Bitcoin is simply an asset class that has trended along with infotech stocks. But and I've got this thesis. I think that these prices in cryptocurrencies are dependent upon the same animal spirits that have made Bitcoin the leader of the infotech sector for the past 15 years. But am I willing to admit that I'm wrong, perhaps in the future, and that maybe there is some real long-term value to Bitcoin or other cryptocurrencies? Sure, that's possible. But we're seeing a decrease in the rate of change in Bitcoin. Even Michael Saylor has recently come out and said that Bitcoin may become boring. It become a boring investment in the future, and I think that's probably an early sign. This sort of stagnation in the rate of increase that we're coming closer to a top. So I think so far this long-term wave pattern that we have for Bitcoin has been working very, very well. Elliott Wave International's cryptocurrency service has been monitoring it very well. I've been monitoring it very well in recent years in my newsletter, but it's we'll see what happens. But gold, just to get back to the original question of havens against inflation, for example, gold is not going away anytime soon. It's been around for thousands of years, and it will continue to be a haven against inflation in the future. So that's why, especially at this juncture where the infotech sector has, I believe, is coming to the end of a supercycle advance, including cryptocurrencies. I think that gold has the much brighter long-term future.
All right. Perfect. Thank you for that, Mark. While I uh, look through these last few questions here, did you want to go ahead and share that screen for the contact information that you had, or?
Sure. Let's see. Let's see. How does this? I'm looking at other questions myself here. What and when will be the magnitude of the next stock market correction? Let's exhaust some of the questions before we go on.
Okay.
Yes. Now he's talking stock market correction. This is Theodore, S. Theodore here, Roy. Again, when you get to the end of that five-wave advance in the Nasdaq, you're going to see the largest correction that the Nasdaq has experienced since the 2000 to 2002 bust. And I think that, of course, cryptocurrencies will go along for the ride. So what was the decline in 2000 to 2002? It was about an 80% decline. And I think that if that repeated, I would not be surprised. On the other hand, bear markets can also come in the form of long sideways corrections. You can exhaust people the same way. Just as, for example, emerging market stocks have exhausted people and commodities have exhausted people, during their 13-year, and some would say even longer, sideways correction. So that's a scenario as well. So, so it's not just when you say magnitude, that's a good word, because it may not just be the depth of the correction. It may not, even if it doesn't match an 80% decline like in 2002, you might see a 15-year correction in tech stocks. That would be something, we haven't seen in decades. But it's going to be large. I mean, but look, I mean, even if it's just a 50% correction, it's something that investors need to be aware of. And it's certainly a possibility that needs to be considered. You're going to have, if you have a 2027 top, if I'm correct about 2027, that's a 25-year secular bull market, or supercycle, as I could call it, in Infotech. And so the correction of that should last several years at least, and should be severe in terms of a percentage decline. So that's how I'll say about that. And here's another question. S. Theodore Roy is asking about, would you recommend retail investors purchase other metals such as copper, silver, palladium, and platinum? Yeah, I would say that the easy entry was back several months ago. Certainly in uh, things like palladium and or sorry, platinum was a good entry that we were on top of. Copper has already had a good run. Copper, sorry, I was thinking in terms of miners in particular. Copper miners are having a good run right now. It's very difficult to buy into the current market environment. We've had an excellent run from the April lows. If you look at the leaders of that rally, we're talking Palantir, Bloom Energy, Credo Tech. Some of the quantum computing stocks have absolutely soared. Astera Labs. These are leading edge companies, but they've already increased, certainly doubled, tripled in some cases, quadrupled in some cases just since April. So the metals are part of that as well right now. And so I have to admit, it's difficult to buy in the current environment, this current momentum environment. But I would say, wait for some pullbacks, which we may get if we're lucky over the next several weeks, perhaps in an autumn correction. And then, yes, I mean, I have to admit, I'm a little bit concerned about gold because it's had such a strong run so far. But some of the other metals may off, and silver also has had a really strong run too. It's really tough in this momentum environment, but that's why I would say let's see what happens during the next correction, which hopefully we'll get later this autumn, but we'll see about that. So let's see. Any other questions? Do you have any other questions coming in, Mark?
Um, I have one here. Uh, how should a retail investor think about portfolio allocation between precious metals, Bitcoin, and other commodities under your framework?
I'm sorry, can you repeat that again? I didn't hear
Uh,
you.
um, can you hear me now?
Yeah, I can hear you now.
Okay.
Go ahead. It's okay.
Okay. How should a retail investor think about portfolio allocation between precious metals, Bitcoin, and other commodities under your framework?
Hmm. Well, I mean, that's ultimately a personal preference. I mean, you could say there are people who will recommend 10% in precious metals, right? Whether it's the metals or the miners. That also depends upon the juncture. It was lower risk several months ago to enter into the miners, and even into silver. Um, at this point, after the run up, you can't. I mean, you can't go into with the same percentage of your portfolio that you would have put several months ago, because the risk is simply higher based on the price increase. So I can't answer that. And ultimately, it is a personal preference. How much do you put into gold? Is it 10%? Some people would put 30%. Some people would put 50%. It's a really difficult question. But I'll leave you with that. That's a tough question to answer.
Okay.
Yeah, thank you.
Yeah. Thank you, Mark. Um, see here. Here's an interesting question. Could gold and Bitcoin serve complementary roles in a portfolio rather than being direct competitors?
Oh, well, if we go back, in fact, here I can share my screen because I would like to go back to that first chart that I showed about gold and Bitcoin and how they compare or how they relate. Can I go ahead and do that? Can I
Yeah.
share the
Yeah.
screen? Yeah. Okay. Here,
Absolutely.
let me screen. I think it's screen one, and you should have right. Okay. So this is the beginning of the presentation, and the first chart I believe, is right here. Right. So this is, again, Bitcoin and gold, they're not correlated, right? I mean, you're going to have significant performance results from these two assets over time. And we've had a huge run in gold. In fact, I wouldn't be surprised if we were to get a significant correction at some point soon. Um, Whereas in Bitcoin, it's not exactly going through the roof as it had been back in the early 2010s. So, and on the other hand, you have to watch in Bitcoin. I think, let's see, where did I put yeah, the trend channel line. This trend channel line, this is a proper Elliott wave trend channel. I didn't discuss it in the video, but you can see here that the lower trend channel line begins at the end of wave 2 and it goes through the end of wave 4. And actually, this is something that needs to be watched carefully. If we were to get a breakdown below this line significantly, you need to tolerate some diversions outside of the line sometimes or outside of the channel. But if we were to drop below the 100,000 level, as I mentioned in the video, that would be a bad sign because we would then be outside of the channel. So before we even talk about, whether these two asset classes can play complementary roles, within a portfolio, I would start, questioning whether you really want to hold Bitcoin at all at this point, especially, or sorry, you can at this point because we're still above the line. But if we break down below it, the question is not whether you want to, put a percentage of your portfolio into Bitcoin, but whether you want to hold it at all. And that would be true as well for the, NASDAQ stocks and tech stocks in general, as I pointed out in the video. So at this point, this is a really tough juncture for both gold and Bitcoin, as we saw here in this first chart, because they both essentially have had very, very strong rallies. And I think, again, I'd be waiting to see what kind of a correction we get in the near term. You want to enter not after strong rallies like these have both had. You want to enter after a correction, or at least during the beginning, for example, a breakout, right? Multi-year resistance lines being broken out like in early 2024 or so over here. And now though it's a much more difficult environment. If you're already holding, that's a different question. And this is, the question is, do you want to, for example, reduce your holdings of Bitcoin or reduce your holdings of gold? At that point, if you're in at a good entry, some percentage below the current prices, I think that you're in a good situation, and you may want to consider holding through any corrections, except in the case of a significant breakdown in the price of Bitcoin. But so that's it's these are tough questions, which ultimately you're going to have to decide for yourself, I think. So
All right.
thank you.
Yeah. Well, thank you very much for that insight, Mark. I believe we are out of time. I enjoyed your
Oh, okay.
presentation very much. And thank you to the attendees that joined. I hope that they enjoyed it as well. And
Okay.
we hope to see you again sometime soon, Mark.
Okay, great. Thank you very much, Mark. Have a
All
good
right.
day, everyone, and
Bye.
good luck with your investment.